You've saved the majority of your money in pre-tax accounts, such as your company 401k or now your IRA. And now that you're about to retire, you may be wondering, how do I spend this money? And more importantly, how do I spend it in the most tax efficient way possible? My name is Kyle Kuyat. I'm a certified financial planner and co-founder of Defining Wealth. And in today's video, I'm going to walk you through a case study of how to do exactly that. If you'd like to follow along, you're welcome to try our software that we use for our clients completely for free. Click the link down below. So for our example today, we're going to look at Bill and Stephanie Spring. Bill is 61 and Stephanie is 60, and they're getting to retire next month. The Springs really had three main goals. First, to be able to comfortably spend at least $8,000 a month in retirement. Second, to have the most tax efficient retirement possible. And lastly, to leave money behind to their 4 children, as well as grandchildren and future grandchildren. And let's first look at a breakdown of their assets. As it stands right now, they have about $50,000 in their joint money market account. When it comes to their investments, Bill's 401k has about $1.4 million in it. It's all pre-tax. Stephanie hasn't worked for a while, but her 401k has $275,000 in it. They have a taxable account and a joint brokerage account with about $225,000. And then they both have small Roth IRAs, about $50,000 each. So as it stands right now, their tax diversification is definitely more weighted in pre-tax accounts. As you can see right here, about 83% of their overall assets are in pre-tax accounts, meaning at some point, we're gonna have to pay taxes on these in the future, which we'll get to in just a moment. They have about $225,000 or 11% of their assets in taxable accounts. And lastly, a small portion, about 5% in tax-free or Roth accounts. Now, for most people, especially those that worked a W-2 job like Bill and Stephanie, the reality is you have more control now over your tax situation than you have for almost all of your working life. However, you also have more money than you have in your entire working life. And I almost equate retirement income planning like a Rubik's Cube. If you think you make one decision and everything looks good, you flip it over and it impacts everything else. So then the question becomes, how do we make the most confident decisions, specifically when it comes to minimizing taxes in retirement? Let's jump back into their plan. So as it stands right now, Bill and Stephanie want to retire in the next month. They want to spend about $8,000 a month in retirement. We've baked in some healthcare cost as well for them. In addition, we also bake in long-term care, but that's a story for another day. So as you can see in the beginning here for Bill, he's probably going to be in the lowest tax bracket that he sniffed out for decades of his working years. So what we're trying to do is smooth out this tax ride as much as possible in order to limit his lifetime tax liability that he'll have from where his money is today. Well, as you can see at age 75, once RMDs kick in, there's going to be more money coming to them than they really need to spend on a monthly basis based on their expenses. In addition to that, what that's doing is kicking them into a higher tax bracket. So the question then becomes, how do we smooth out the tax ride to create the most tax efficient retirement possible? So one of the strategies that you can implement is what's called Roth conversions, which is simply paying the taxes and choosing when you want to pay the taxes on your pre-tax accounts before RMDs kick in. Essentially what we're doing is paying taxes today, moving it into a tax-free bucket so we can avoid paying taxes in the future, and that money will grow tax-free and come out tax-free to us throughout retirement. So Bill came to me and said, Kyle, I don't know if these Roth conversions are right for me. I saw something on YouTube. I'm not sure if I should do them, how much I should do, and most importantly, when should I do them? Can you help me out? I said, Bill, I got you, brother. So here's the plan as it stands right now. This is with no conversions, and you can see at age 75 is whenever RMDs are going to kick in, when that time comes for both Bill and then for Stephanie. What these lines are going to indicate are the individual tax brackets. So you can see up to the 10% bracket is the blue line, up to the 12% tax bracket is the green line, up to the 22% tax bracket is the yellow line, and so on and so forth. So I told Bill he has about a 14-year runway from age 61 until age 75 until RMDs kick in. Now, this is going to vary depending on your situation. Obviously, the older you are or the closer you are to RMD age, the shorter runway you're going to have to do these conversions. That can potentially make it more or less attractive, being that you'll have to get as much pre-tax money to Roth in a shorter amount of time, and all that's going to do is push you up into a higher tax bracket. So what we wanted to test first was, okay, what happens if we fill up the 10% bracket? You can see that's a positive change in the plan. Bill will have almost $400,000 more in tax-adjusted assets towards the end of his plan. Now, the blunt reality is that's probably not enough. You can see we still have an RMD problem here. So we wanted to set the speed limit or the Roth conversion limit a little bit higher to about 12%. You can see that makes even a more impactful change on his plan. Now, here's the reality. Whether it's you testing this in here, me testing it and showing it to you today, think of filling up that tax bracket as a speed limit. It's a great testing point. However, Roth conversions are one of the things that you want to do on a year-by-year basis. And in some years, they might be actually more attractive than others. Let me explain. Think of strategic Roth conversions like buying the dip during your accumulation years. When the market's down, you decide to buy in because it's on sale comparatively. And we're going to hope that it recovers because we have time on our side. With Roth conversions, it almost works the same exact way. I told Bill I'd be actually okay with you going over this speed limit should the opportunity present itself. So let's say, for example, at age 65, if the market was to go down, I'd actually be okay with him filling up the 22% tax bracket and converting on sale and letting that recover tax-free for the rest of his retirement. Now, that's extremely hard to test in these plans, but I did want to give you a real-world example as to how that works and why it's important to stay on top of this throughout your retirement. Either way, this is still a great illustration to show the power of conversions and how this could impact your retirement. So if we test the 22% tax bracket, you can see that's even a little bit more beneficial. However, what we're not trying to do is fill up the maximum bracket because you can see that's actually not a net benefit to our plan. So the goal isn't to convert everything up front, it's to smooth this out as much as possible throughout our retirement. The other thing that came up in conversation with Bill and Stephanie was that, well, Bill's health isn't the greatest. And Bill was worried about if something happens to him, what would happen to Stephanie? Well, the reality is if we go back to not doing these conversions, you can see the RMD impact for Bill while he's still living. What this doesn't take into account is if Bill were to pass away, let's say, for example, at age 80, Stephanie would still have a large amount of pre-tax money. And now that she's going to be filing single, she'll be even in a higher tax bracket. And if they wanted to leave money behind to their kids, I much rather have them leave Roth dollars than pre-tax money for a couple of different reasons. First and foremost, if your kids inherit pre-tax dollars, they have to take it out over a 10-year window. However, if they inherit Roth dollars, it's not taxable to them. This becomes even more important because by that time, your kids are likely older and in their highest peak earning years. The other thing to note is if we do these conversions, Bill and Stephanie are retiring at 61 and age 60. So they're going to have to pay for health care, and that takes ACA almost off of the table. I would submit for their plan, we ran the math on this, doing Roth conversions is a much higher dollar and cents impact item than trying to thread the needle for ACA credits. However, that's going to depend on your situation, but more likely than not, from what I've seen, if you're around this asset level, Roth conversions are typically going to be where you want to overemphasize versus trying to thread the needle on credits for a few years. Based on the dollar and cents impact and the overall savings to you, if we zoom out and look at your overall retirement. Based on all those factors, Bill liked actually filling up the 22% tax bracket, which is what we landed on. And we decided that, hey, we can either scale that back or scale that down depending on the year. If you look at the overall summary, his tax adjusted ending assets are going to be higher. They're going to save about $500,000 in federal taxes paid over the lifetime of their retirement, and they'll have to take less money out of their tax deferred accounts as time goes on. You can see the impact to their overall plan. They're still in a good spot. However, they have a lot more money at the end of the day if we did these conversions, which was the end goal for both Bill and Stephanie. Hopefully this was helpful to you in understanding your situation. Again, as mentioned, the tool is down below. Check it out for yourself. If you have any questions, feel free to reach out to us. We'd love to have a conversation to see if this is right for you. My name is Kyle Kuyat. Thank you for watching, and I'll see you next time.